Wall Street operates on a central, unifying assumption. Despite the immense computing power and armies of analysts, predicting the market's exact movements is widely considered an impossible task. No one has a crystal ball. When sudden panics hit the trading floor, the chaos strips away all advantages. Even the most seasoned institutional investors and billionaires routinely watch enormous portions of their wealth evaporate in a matter of hours. We have nearly a century of evidence showing what happens when the floor falls out. The wealth destruction cascades downward, moving from institutional ledgers to the absolute human toll on regular citizens. Amidst that predictable chaos, regulators eventually noticed a glaring irregularity. While the rest of the market bled capital, one untraceable digital account, operating behind the alias Ghost, did the exact opposite. During one particularly severe drop, this solitary account triggered a sequence of perfectly timed short positions. As broader indexes plummeted and standard portfolios collapsed, this unknown trader pulled millions of dollars in pure profit from the decline. A single isolated win can be chalked up to blind luck, but regulators watched this exact sequence repeat. Across multiple distinct market panics, the account executed identical maneuvers without a single recorded misstep or loss. The account consistently moved days before any public signal of a downturn. This degree of foresight indicates that the timeline of a market crash is visible to those with the right tools, long before the panic begins. On the physical trading floors, whispers of these impossible trades began to circulate. A quiet paranoia set in among financial insiders as they realized someone out there possessed an informational advantage they could not see. While the broader market trendline showed steady growth, the trader took out massive short positions, negative data points clustering at the top, betting against major companies before a collapse. Watch the market line collapse. As fear peaks, short positions spike, and the account extracts the capital. Federal regulators recognized the mathematical impossibility of these trades. They quietly launched a series of unpublicized investigations, attempting to trace the capital flows without alerting the press or triggering wider market instability. Every subpoena and digital trace hit a wall. The investigators uncovered layers of offshore shell companies, registered to fake commercial addresses, all communicating through heavily encrypted private servers. An entity capable of moving hundreds of millions while remaining invisible to federal monitors operates outside the reach of standard financial law. The operation culminated during a period of widespread financial instability. Corporate earnings were high, volatility was low, and institutional experts felt entirely secure in their long-term growth models. In the middle of that bull run, the Ghost account mobilized. It executed a heavily leveraged maneuver, placing a massive, multi-billion-dollar position that bet aggressively against the entire United States economy. The capital requirements for a trade of that size were staggering. Financial analysts who caught wind of the position openly dismissed it, viewing the contrarian bet as an expensive mathematical absurdity. Their dismissal lasted a matter of days. A sudden liquidity crisis triggered cascading sell-offs across multiple sectors, resulting in an immediate financial crisis that validated the short position entirely. The account's returns scaled exponentially as the broader economy seized up. The initial multi-billion-dollar wager generated hundreds of millions in pure profit overnight. While this massive transfer of wealth occurred invisibly on the servers, the physical trading floors erupted into visceral, uncontrollable panic as brokers watched their portfolios disintegrate in real time. Extracting that volume of capital from a global collapse elevated the stakes. Pinpointing the individual or organization behind the screen became an immediate imperative for financial security agencies worldwide. Then, the trades simply stopped. Immediately following its most lucrative maneuver, the account liquidated its holdings, erased its digital footprint, and went entirely dark. Federal authorities eventually tracked the IP addresses to a physical commercial office space. When investigators breached the doors, they found the suite entirely abandoned, wiped clean of servers, paperwork, and any forensic evidence. The precision required to execute the exit strategy spawned several theories. Investigators debated whether they were tracking a highly coordinated financial syndicate, a foreign state actor, or a high-ranking insider with illegal access to proprietary data. This lack of resolution shows that even with global data tracking and real-time auditing, an entity can extract a fortune and exit the market without triggering a single regulatory flag or identifying digital footprint. The operation laid bare the structural weaknesses of global markets. If someone with the right algorithms and capital can obscure their identity, the system remains highly vulnerable to anonymous manipulation. The predictive methodology used by the ghost remains a viable instrument in the current global market. The same infrastructure that allowed the trades to happen remains largely intact. It's highly probable the architects behind the account are simply monitoring data streams, quietly waiting for the next cycle of economic instability to peak. Market corrections will happen. The real risk resides with those who can observe the data from the shadows, converting a global crisis into private profit.